Yeah, a little bit.
Okay.
So we gathered a whole bunch of data so you can have context in what you should be focused on and what's going on around you.
Some of you are gonna like it, some of you are not, but here's the thing. You're here already. You're winning. There is a lot of things happening in the market. We're gonna go through everything, and we're gonna give you the data. So I would encourage you guys to start taking photographs of some of these slides, because you're gonna wanna refer back to them. We're gonna give you a heck of a lot of stats. Alrighty, so let's start.
Yeah, a little bit.
Okay.
So we gathered a whole bunch of data so you can have context in what you should be focused on and what's going on around you.
Some of you are gonna like it, some of you are not, but here's the thing. You're here already. You're winning. There is a lot of things happening in the market. We're gonna go through everything, and we're gonna give you the data. So I would encourage you guys to start taking photographs of some of these slides, because you're gonna wanna refer back to them. We're gonna give you a heck of a lot of stats. Alrighty, so let's start. Everyone is talking about the economy, but let's break it down a little bit. So it's not just jumping off the cliff just yet. There are more jobs available than people looking for work, right? Unemployment is at historic lows, 3.8%. So these are all good things. There's almost 9 million job openings right now. The average price of an hourly wage is $29. That's ridiculous, right? It's actually more than what some people are making when they first enter this business.
Yeah.
So that's crazy. So what does that
Good
mean?
news. I'm going to give you some of the bad news.
All right.
Consumer spending and consumer confidence normally go hand in hand. They're coupled. But since COVID, for the first time, I think ever, they've been completely decoupled. And if you look at the years, COVID is really what destroyed our confidence, but not our spending. So for the last couple of years since COVID, we've been spending at a much higher rate than consumer confidence. So that's the canary in the coal mine typically from economists, that there is a recession coming. So unless US consumer confidence increases, there will be a pullback on spending, because right now anywhere you go, there's a line, right? It doesn't matter if you're at a restaurant, the grocery store, trying to buy a plane ticket. It feels like you're competing for everything. But that could come back real fast.
Because during COVID, we couldn't spend money, right? I mean, aside from like Amazon, a lot of you were trying to spend money, but none of you could. But the second they freed us up, how many people went on vacation? Yeah. How many people sort of went out the door, started doing restaurants when restaurants were opening up again? So here's what happens with that. Our consumer credit card spending has topped, ready for this? $1 trillion for the first time in history last quarter. Who said woo? Why are you sort of saying woo to that? You're like doing a lot of Amazon shopping. Now, this is also happening when credit card interest rates are like at an all-time high. It's 27, 28% on average. So when you're looking at that and we just keep spending, we're spending at a 28% rate, and your cost of living is higher, right? People are using their credit cards just to make ends meet. It's a huge red flag.
Yeah. So, and some more not good news is personal savings are now at a historic low. You can actually see right there the huge spike when they locked us up. No one could spend any money. US savings rate went to an all-time high of 35%. But very quickly thereafter, they went right back down. And so, again, we're not just coming up with random facts to tell you, we're telling you a story, so we are telling you where to focus on in your business in the next coming 12 to 18 months.
So, inflation may have peaked, right? But here's the thing. The Fed keeps raising rates, and they're raising it really quickly. The last time that the Fed fund rates were this high was in the 80s. Some of you weren't even born I don't think you were born.
I was born in
Were you?
I was born in India.
All right. So I was there. Jeff, you were born, right? Yeah, okay. So, but they even then, they did it on a gradual step-by-step up. So the Fed's aggressiveness of what they're doing with interest rates has sort of some economists thinking we might be leading into a recession.
So, this is the 24th consecutive quarter over quarter decline in sales. If it feels hard out there, it's because it is. We're on track to have probably the lowest home sales on record since the Great Recession. The last time we sold this few homes was 2009. Who was licensed in 2009? Yeah. This is really different for us because we all feel like we're there, but everyone's still buying stuff and running around, and we think we're fine. But in our industry, we are in a recession of transactions, right? Look at the peak in 2021. It was almost 7 million homes between resales and new construction. That's almost a 40% drop, right? So you guys need to have this context and have some grace with yourselves.
That's right.
There is some folks running around in today's market going, God, I don't know if I want to do this anymore. Right? Rates are 7.5%.
I mean, has anyone ever felt that? I thank you for that honesty, right? Look at these hands. Like, this is a lot, right? But when you start looking at this, look at what the market truly is. You guys are crushing it.
Yeah.
So let's go back to mortgage rates for a second. So according to Freddie Mac, this was the first time in history that mortgage rates have doubled in a calendar year. Doubled. And it wasn't just in a calendar year. It happened in a span of just a few months. So that meant that a homeowner that was looking at their monthly payments, now we're at a 45 to 60% increase. So they couldn't afford that home anymore, right? So the purchase loan applications have fallen dramatically. They're off about 30%. And so when you start thinking about refi, who's going to refi, right? Refis are down 80%. Here's what's crazy, 70% of the folks that are homeowners have an interest rate below 4%. So those that are in this inventory circle, there's a 3-month supply there, those are the people that have to sell, right? So start thinking about that with your business. These people have to sell. Let's focus on those that have to. How many times have you guys not said to yourselves, I'm not going to call my client, he's got a 3% interest rate, he's never going to sell. Sometimes they need to sell.
Absolutely. So, one of the things that happened in that dramatic change we experienced is the appreciation has come almost to a complete stop. So one way of thinking that is buyers now have a reprieve, right? Remember 18 months ago, if you waited a month, the prices went up 10%? That wasn't sustainable. That's pretty much gone, and I think that's actually a good thing. I live in Miami, and our market doubled in 4 years. Right? That's not sustainable. So across the board, we're seeing that really calm down. And then this is where you guys need to be the local expert, right? Some markets are faring very differently than others. And the problem with the way we consume content is we all read headlines, right? You see them on social media, you see them in your group chats, people will send you headlines. And what's happening in Austin and Phoenix and San Francisco is completely different than what's happening in Houston, Miami, or Nashville. And that's why you need to be a local expert, because you'll be talking to a consumer who might say, oh, it's a terrible time to buy or sell, depending on the market you're in. So it's very important that you know these numbers cold and you can speak to it in a professional manner.
You know, and you and I just spent a good portion of this calendar year traveling around the country with our master clients, and we found out how different every market was. And so what really is interesting now, that there's a different phenomena happening. Because of the cost of what it costs with money coming in. So builders are actually building smaller and less expensive homes in order to offset that higher cost of financing. So our market is changing. Our market inventory is changing. Single-family housing starts in August. We're down about 12% from last year. But here's the good news. Permits are actually going up. So builders are actually optimistic about the future of the housing market. So that's the positive news.
Well, and on that note, think of the takeaways. Are you working with buyers, putting them into new construction? And are you working with builders who are sellers? So always think of how this affects you and your personal market. So this is the most recent data we have, but across the United States, 26% of purchases were by investors in the month of June. Right? I can see some of the size of the audience. What most of you probably just thought when I said that, you thought those were the hedge funds and the institutional buyers, all the folks that have been running around buying up a lot of residential homes. But that's actually not the case. Interest rates affected large funds just as bad as they affected everybody else. The vast majority of those 26% of homes were purchased by small to mid-sized investors who've been sitting on cash, where that cap rate doesn't matter where rates are at. What does that mean? Is that every one of you needs to be having these conversations in your local market. There has been folks sitting on the sidelines waiting for the dumb money to get out of the way to be able to capitalize on that. So you should have a portion of your business. And again, 26% is a national average. Some of you live in markets where that's 35 to 40%. Right? So you should look at your business and figure out what percentage of that market share you capture, because if you not, you're leaving that much percentage of the business on the table if that's what's happening in your home market.
So how many of you were in the business in 2009? Oh, okay. So about a quarter of the room. So those of you that are waiting for 2009 to happen again, it's just not, right? So we're talking about delinquencies. We're talking about things that were those REO products, things that went into major foreclosure. And those where a lot of you made a lot of business because we were dealing with those hedge funds back then, that they were buying up the bank inventory. That's just not happening anymore. So mortgage delinquencies are actually at a historic low. The Mortgage Bankers Association reported that 3.37% of mortgages were delinquent in the first half of 2023. So the typical number is about 5%. And get this, borrowers have amazing amount of equity in their homes to the tune of $27 trillion. They're not going foreclosing. The foreclosure activity is at 60% of our pre-pandemic levels. In a normal year, it's about 1.5%. Right now, it's 0.57, just over a little bit of half of 1%. That's insane. Leo.
Yeah, so each market cycle is different. You'll hear the terms delinquency, foreclosure, REO, and think of them interchangeably, but it's actually a sequence of events. So folks in delinquency are still in trouble, and based on all the stuff we just told you, it's coming. Folks are in trouble. Folks are struggling to make ends meet. But the substantial difference is that 88% of borrowers in foreclosure sampled last month had north of 20% equity. What that means is that homeowner will most likely list with an agent. And to Michael's point, a lot of you let that little voice inside your head hold you back.
Yeah.
And you're not making your phone calls, you're not making your contacts because it's a fist fight out there. And you're like, I'm not calling him. I just sold him a house 3 years ago and he's got a 2.8% rate. He doesn't need to sell, she doesn't need to sell. But the reality is, some of the direct marketers in this room will probably get to them first because they're doing all their activities. And if you don't get in front of that homeowner, someone else is going to list that home. Look at that. 64% of distressed sellers are selling ahead of the foreclosure sale. So make sure you're making your calls, you're getting in front of your people, because that is how you actually take care of the people you care about, that you put.
That's an important stat. 2/3 of all the distressed sales happen before it goes to foreclosure, right? So if someone is going through some financial hardship, they're probably not going to share it with you, but you could be their lifeline. So this is important data.
Yeah, and that could look like sending CMAs to folks you've sold homes to who may not even be aware of how much equity they've gone up.
Absolutely.
Because they're probably heads down worried about their financial situation and not realize that they may even have a couple $100,000 more in equity than when they bought the house. All right, so we're going to wrap this up for you guys with some key takeaways. The recession is still a very real possibility. It will just look different than the ones before it because we don't have high unemployment. Other ones are typically indicated by that way. Well, I got ahead of myself. Mortgage rates continue to be at a 20-year high, and none of us have a crystal ball, but I can tell you that they will be much higher than you've experienced for the last 10 years of selling real estate. Existing home sales are on pace to be the lowest since 2009. Resales, home sales are broken down into two categories, resales and new construction. This will be the lowest year of resales. We will be sub 4 million. That is actually about 300,000 shy of what everyone predicted at the beginning of the year. The only bright spot was new construction will probably hit 675,000, which is higher than everybody was predicting. So again, make sure you remember to meet with your builders and understand their inventory. Price declines on new homes have been a reaction to the market. So the shrinkification you're seeing at the grocery store, where the bags are smaller and you're getting less units, builders are responding in kind to try to get people into homes.
So what else do we need to focus on? It needs to be on the homeowner that needs to sell. Start thinking about those that are needing to sell. If you're thinking about selling, you're not going to sell. You're at a 3% interest rate. You're not going to sell. Think about those that need to sell. So investors are continuing to account for a large percentage of residential purchases, right? So they need to be a part of your business plan. They just have to be. This is how you're going to survive this market. The anticipated wave of distressed properties never materialized. They probably won't. So stop waiting for those foreclosures to come in. And the opportunity to move upstream and list properties for distressed homeowners that still have a lot of equity. Leo.
All right, so let's talk about our numbers, because again, those that know me know I love data. And this is where context is super important. When you see, we're down 21% over last year and 20% over that year, so we're down 40% over the peak. You got to know your personal numbers. So we take Q1 and Q2 of 2022 and Q1 and Q2 of 2023 and do the industry. The industry was down 21%. We were down 15%. That means everyone in this room collectively outperformed the market by 30%. Yes? And we didn't cherry pick the top 1,000 agents how other companies do it. We're giving you all of it. And we went, if you do the math, we had a 3.5% market share. It increased to 3.85%. So we've increased our market share 7%. Yes, no clap for that. And you need to go home and do that for yourself, because probably if you sold 100 homes last year and you're down to 80, you're beating yourself up. But in your local market, you could have not only increased your market share, but outperformed your market. And it's important that you understand that.
If we don't see 5,000 shares of this with all of you on social media, you're not doing your job. This is amazing. What we're doing as a company, as a team, as all of you are doing, this is crazy. You're outperforming the market by 30%.
Yes.
Come on. Come on. This is you. This is damn awesome. I get excited.
Yeah, I get excited too.
All right, let's talk about what else we're doing. We just met Michael Bean and his team, and Glenn just talked about Boost.